Today, I am thrilled to introduce Michael Green as our speaker today. Michael is a portfolio manager and chief strategist at Simplify Asset Management, where they're focused on making institutional grade alternative strategies available to all investors through low cost and transparent ETFs. Prior to joining Simplify in April 2021, Michael spent his career managing capital, strategies, and investment teams over firms like at Logica Capital Advisors, a hedge fund focused on trading volatility, Thiel Macro, an investment firm that manages the personal capital of Peter Thiel, Ice Farm Capital, a discretionary global macro hedge fund founded by Michael and seeded by Soros Fund Management, and Canyon Capital Advisors, a $23 billion hedge fund where he founded the New York office and established their global macro strategies, and they managed in excess of $5 billion. In addition to his work as a market theorist and portfolio manager, Michael has been noted for his work as a public speaker and financial media participant. He is a graduate of the Wharton School at Penn and a fellow CFA charter holder. Personally, I've been following Michael and his research for some time now. It's been instrumental in helping me formulate sort of updated views on the markets, their structure, and why certain phenomena might actually be happening, especially lately. I will say as a word of warning to anyone who hasn't heard Mike speak before, his research and messaging on passive investing are somewhat like taking the red pill in the Matrix. Once you've listened to his thesis, there is no going back. The world's going to look a little different to you, and that was very much the case for me. So you're forewarned. Without further ado, Michael Green.
Okay, everyone can hear me clearly? All right. The best part is I've decided I've changed all of my opinions. You don't need to worry. It's going to be totally fine. No, seriously, there is a red pill element. If you want to leave and keep your world sane, go for it. Door's right there. You've still got a few seconds left. So I call this presentation the greatest story ever sold. And it's about the impact of passive investments on markets. And the reason why I emphasize the selling part is because that's really what this industry is about. We all know that it's about selling our services. We all know it's about getting clients to put their assets to work with us. John Bogle was doing nothing any different, right? He stumbled across a strategy and a theory that allowed him to compete with his former employer. That the success of that unintentionally contributed to the markets that we see today, and it's the growth of that I find it candidly surprising that nobody's really questioned and challenged. The CFA curriculum, I actually am in conversations with Charlottesville about this stuff. Like, the simple reality is if you want to get the latest academic theory in terms of how these things are impacting markets, and there's a growing body of academic literature. I've got an appendix at the back that just begins to touch on this stuff. The simple reality is probably the earliest we'll be able to get it into the CFA is about 2035. Right, so remember, just as science progresses one funeral at a time, when I die, we can move forward. Okay. All right, so most important thing to understand is how big this has become and how fast it became so big. Right, in 1995, passive was less than 2% of the market. And when I started in the industry in 1992, like, nobody really even talked about it. It was just presumed that this was this little oddball thing that was happening over in Malvern, PA. From about 2% in 1995, by 2020, we were north of 40% in passive strategies. And importantly, that's not just looking at the mutual fund world. That's incorporating things like futures. It's incorporating things like total return swaps. It's incorporating separately managed accounts. All of these are contributors to the dominance of passive strategies. But to think that something going from 2% share to 40% share has not structurally changed the market is just kind of silly when you really think about it. Right? There's also been key regulatory events that have occurred along this path, and that's the other part of the story. It's not just a marketing story to us and to our clients. It's also a marketing story to Washington, D.C. And Vanguard and BlackRock dominate and control the marketing at this point. Vanguard individually outspends the rest of the industry. The ICI budget comes from Vanguard and BlackRock. They make up the majority now of the ICI's budget. And so there's nobody out there who's actually talking about this except, kind of stupid people who start up small ETF firms. Huge change happened in 2006, right, with the Pension Protection Act. Most of us will remember this. This was the change where 401ks went from opt-in to opt-out. This is a really big deal because once we shifted from people having to choose to participate in 401ks to have to choose not to participate in 401ks, we had to change the way the entire system worked. We established what were called qualified default investment alternatives. I know this is a knowledgeable audience, so you'll know all that stuff. But when we did that initially, well, the idea was like very straightforward. Hey, let's do balanced funds, right? We should just automatically put people into some mix of bonds and equities. And that was actually a large chunk of what spurred the growth of firms like PIMCO from 2006 until about 2012, when balanced portfolios took off and the combined skill of equity and bonds, huge deal, right? In 2012, the rules changed again. Target date funds became QDIAs, right? So target date funds would simply ask, how old are you or when do you plan to retire? That became the default investment. They're managed automatically. They're largely walled off from anyone else in the industry. So if a corporation chooses a target date vendor as their 401k plan, nobody else in the industry gets to see those assets. Crazily enough, something like 90 cents on every investment dollar in 401k plans is now going into target date funds. And they never leave. They just never change their allocation. Right? We got really lucky that the DOL fiduciary rule didn't pass. Because the DOL fiduciary rule would have taken all of this and supercharged it. It basically would have made it borderline illegal for asset managers or for allocators to choose anything other than low-cost passive. It just exposed you to way too much liability. And I like to joke about that dynamic. Through the course of my research, I've realized something that most of you probably grasp intuitively, which is Einstein was totally wrong. The most powerful force in the universe is not compound interest. It's liability avoidance. And that's really what this is all about at this point, is it's just people are choosing the safe choice. Whether that's a function of a corporation that's trying to minimize the liability and responsibility that they have, or whether it's an individual who's basically saying, man, I don't want to think about this stuff. Right? They're all choosing the safe, protected choice where they're all in. We also know what happens when everybody does the same thing in markets. That's what a bubble is, right? And so we have participated in the growth of what I would call the passive bubble. I apologize that it doesn't blow up here. I usually have a more active presentation. The tiny chart on the right is actually a study that was done in 2022. This is speaking to the dynamics of academic literature. The passive ownership share is double what you think. So one of the amazing things is if you look at the literature that came through in 2020 and 2021, I started reaching out to the authors and saying, hey, wait a second, you guys are way underestimating how much passive has penetrated the industry, because they were effectively just adding up Vanguard, BlackRock, and State Street. So Alex Chinko and Marco Salmon, both at Harvard, decided to take me up on that challenge and test by saying, when they rebalance the index, what proportion of shares actually change hands? And the answer is north of 40%. Right, so we are way down this path. John Bogle himself recognized that this was a problem, right? If everybody indexed, the only word you could use is chaos, catastrophe, the markets would fail, said in May 2017. Now, he also at the same time presented the observation that I think passive could get to 85% market share, right? Now, there was no research behind that number. That was a guess. There has been no real research that's been done behind that, with the exception of a few studies that looked at what happened if I held share constant, right? So what happens if I run passive's impact, I create the rules of passive, and I run a simulation at 10% market share, or 20% market share, or 30, 40, 50, 60. And they're right, somewhere around 80 to 90% share, the passive becomes so dominant, even in a static model, that it starts to run out of control. And just the easiest way to think about it is the active managers that we've heard over and over again, they're responsible for price setting. right? At that scale of passive, the active managers can't have enough scale to even stand in front of it, right? It's like leaning against the steamroller and trying to stop it, right? So they actually lose their ability to control pricing. But what John Bogle's analysis failed to consider was the dynamic nature of flows. And so starting around 2014, 2015, as the baby boomers began to hit retirement, and I think this is a really, really important thing for people to understand, passive is not homogenously distributed. It's not like you have 40% and you have 40% and you have 40%. Is there anyone in the room under the age of 30? You have 95, right? Those over the age of 60 or over the age of 65 are about 20 to 25% passive as an age group. And so what's really happening is that the younger generation is coming in and has absolutely no mechanism or any awareness on how to even think about active management or allocation. They're just automatically going into these systems at this point. You can actually see how the retirement of the baby boomers began to hit. We actually began to experience outflows. And so today, even though passive is only around 40 to 45%, more than 100% of the flows are actually now passive. Right? What that means is things like the value factor start running in reverse, or small as an asset class starts running in reverse. Why? Because we're firing the managers who painstakingly picked the companies that they like and that they enjoy and that they think are going to add value. They're being fired simply because of the demographics of their customers. Meanwhile, the things that are momentum oriented that have been driven upwards in price, that's reinforced. We're actually seeing that play through. Anytime somebody buys passive, they're just reinforcing momentum. All right, so this is a huge component of it. If you look at the numbers in terms of what percentage of transactions involve any form of fundamental trading, JP Morgan did this all the way back in 2017, which is why I haven't even bothered to update it, although it's gotten worse. Less than 10% of transactions today involve anyone doing any fundamental analysis. All right, so make sure you keep your CFA dusted off. When passive strategies become too large, it really is like standing in front of a steamroller, right? They are going to do what they are programmed to do. Now, I recognize this. I was fortunate in recognizing this going into the events of Volmageddon. In May of 2017, I gave a presentation on the inverse VIX complex and pointed out that the systematic strategies had become so large in this space that they were beginning to affect the behavior of the S&P. You were seeing the beta of the VIX rise nearly exponentially against the S&P. Traditionally, the beta of the VIX is about 4 to 5 versus the S&P. It had risen to 22. Right? That set the stage for recognizing that the inverse VIX ETFs actually were exposed to a move of sufficient size that would actually cause them to collapse overnight. I fortunately positioned myself for it. We turned out great. Got into an argument on stage with the founder of XIV when I presented my work, and I said, look, I think this goes to 0 on a 4% decline in the S&P. He said, you're crazy. This would survive the crash of '87. Went to 0 on a 3.9% decline in the S&P. So I got lucky is the way I would think about that. Product was still listed the next day. Of course, it's back. Now, part of the problem is most of us talk about passive investing. We have no idea what it actually means. Right? Well, fortunately, Bill Sharp in his 1991 paper, The Arithmetic of Active Management, which is kind of the Bible. Anytime you hear anyone say, well, the active managers just in aggregate are the same as the passive managers, are quoting Bill Sharp's work. Right? But what does it actually mean, active and passive? Well, the definition of passive investor is one who always holds every security in the market. And an active investor is one who's not passive. Seems pretty straightforward, except how does a passive investor get into the market? I mean, if they just hold everything, how do they get in? How do they get out? Well, the assumptions of the literature on passive investing are that it's magic. Literally, if you read the papers, it's in the liminal hours when the market's not open. That's when it's assumed that these transactions take place. By the way, you want to talk about the overnight effect? Passive investing impact on markets. So once you recognize that there are no passive investors, right? There is nobody who just holds every security. They transact every single day. And actually, let me jump back. I have to give credit where credit is due. The reason I actually found this was through the work of Lasse Peterson, his partner at AQR, who wrote a paper in 2016 called Sharpening the Arithmetic of Active Management. Many of you will have read that paper. In that paper, Lasse pointed out that during index reconstitutions, the passive investors have to transact. Therefore, they cease being passive investors, and that creates an opportunity for active managers to outperform them during that time period. I can honestly go so far as to say, like, the sole intellectual insight that I had on this was recognizing that he was underselling it because Vanguard and BlackRock take in flows every single day. All right, so they're constantly transacting. They're never passive investors. It turns out that what they are is just algorithmic investors with the world's simplest, possibly dumbest algorithm. Did you give me cash? If so, then buy. Did you ask for cash? If so, then sell. That's it. That's the secret of passive. Okay, so if you actually introduce a player and you take them from 2% market share to 40% market share, and those are their rules, well, what would you expect to have the impact in the market? Well, you would expect to see an increase in correlation in securities, which raises risk, increase in valuation of securities, regardless of fundamentals, as passive share grows, and I'll walk through each of these. Reduced market elasticity, this is the economic term, changes in supply and demand impact on price, right? So reduced market elasticity raises the risk of extraordinary price movements. An increase in market concentration as momentum bias leads to the largest companies becoming larger, and a reduced ability for new companies to become public. Just to frame this, I put this slide together in 2017 and it hasn't changed. Right? I know you mentioned that you saw the presentation in 2020. This slide has been unchanged for 7 years. Okay, what hasn't been unchanged is continued rise in correlation. So this is actually looking at correlation for the components of the S&P 500 going back all the way into the 1920s. You're not going to see this anywhere else because, honestly, I cheated a little bit. Instead of doing a full correlation matrix, which requires a 500 by 500, technically 505 by 505 covariance matrix with instantaneous weights, amplitudes of movements, and everything else, I actually used a mathematical trick. It's called Kendall's tau, in which you simply ask, did they move in the same direction? Right, it's what's called binomial correlation. And over a long enough time period, binomial correlation is going to give you the exact same answer, except it's parsimonious. Right? So it's really easy to solve the question, did two stocks move in the same direction every day? It's really hard to do that 505 by 505 covariance matrix. And if you do this, what you actually discover is this is what correlation looks like. And there's a couple of really key dates here, right? One, my favorite is the 1930s. What we're actually looking at here is the number of stocks in the S&P 500 that moved in the same direction on any given day, right? And it is adjusted for the realized level of volatility. So I'm taking days in which the S&P moves by 1%, by 2%, by 3%, et cetera, bucketing them together so I give basically a picture under constant volatility. All right? One of my favorite experiences was actually debating the BlackRock chief strategist on this topic and him pointing out, well, correlations are similar in the 1930s. And my reaction is like, wait a second, we're at all-time highs, then the market was down 95%. And like, you think those are comparable? Come on. Like, it's just silly, right? It is a silly argument. But he is correct. Like, we did experience high correlations and high volatility in the period of the 1930s, and then they fell with the Investment Company Act of 1940. And the reason why they fell is actually really important. The Investment Company Act of 1940 took away the ability for mutual funds to use margin unless it was disclosed. And in the aftermath of the 1930s, nobody wanted to say, hey, we run levered equities. Right? Now you can get a 4 times levered S&P 500 ETF. That might be a contributing factor as well. But it took away leverage, right? And as anyone who has traded crypto or anything else knows, like, if you use leverage, you create coordinated fail points. Right? The events at which somebody hits a levered point that requires a forced liquidation causes a spike in correlation. Right? So we took that away. We entered into a golden period in which there was very low realized levels of correlation for a very long period of time. And then that suddenly changed in 1994. Why? Because in 1994, Vanguard, having grown from 0% to 1%, really about 1.5% of the market, began to experience tracking error. They'd try to buy all the components of the S&P 500, And they would cause the smallest stocks in the S&P 500 to diverge from the price that they were hoping to trade at. That causes tracking error, which is the end of any sort of relevance as an index fund. Can't manage a tracking error. So they went to the street and they said, hey, what can we do about this? And the street looked at them and they're like, wait, you're trading every single name? Why don't you just buy futures? And the answer to that was, of course, well, we can't, because futures require a margin account. And margin accounts are leverage, and we can't use leverage because we didn't disclose that we were using leverage. And the street said, well, wait a second. You're just trying to offer people the cheapest and lowest cost investment products. The SEC is not going to object. Hire a good lawyer or go to the SEC, get what's called a no action letter, and that's exactly what they did. And so in 1994, the index funds began using futures to enter their positions in markets. Right? Now, one of the great ironies I used to have on this chart, commentary from Warren Buffett in 1982 when the S&P futures were first introduced. And his observation was, for the life of me, I can't imagine why anyone would want to buy these things. I can understand why they want to sell them because they want to X out the market exposure. But why in the world would you want to buy the entire market? That's like totally antithetical. Right? And that was absolutely correct. All the problems and all the uses for the S&P 500 for things like portfolio insurance were around selling. In 1994, that changed to buying. And this is really where our modern markets kicked off. Because crazily enough, that's what caused the dot-com cycle. Wait a second, that sounds insane. That can't have happened. No, what actually occurred was that we constructed the indices so that they were market cap weighted. And most people are like, wait, they're still market cap weighted. No, they're float adjusted weighted. What was the unique feature of the 1990s? We had large market cap, low float companies like Microsoft, Cisco, Dell, et cetera. And so when the index replicators were going to try to buy the stocks in proportion to their market capitalizations, they were buying twice as many shares of Microsoft as were actually available. What happens if I try to buy twice as much of something as is actually available? It goes up, right? It goes up on a relative basis. And so what actually turned out was in that period from roughly 1995 to 1998, the single best performing factor was what was called insider ownership. Right? Why? Well, we constructed all sorts of wonderful narratives, right? You're aligned with the management teams. The entrepreneurs are better managers, right? Like we created all these stories. We didn't have factor funds back then that were like, oh, buy the insider ownership factor. Instead, we did the equivalent. What's very closely correlated with high levels of insider ownership? Recent IPOs, right? And so recent IPOs, in particular technology, took off. By the way, this is the exact same mechanism that caused the Chinese stock market to go up 500% over basically an 8-month period from 2014 to 2015. That's how I figured this out. When I was running my hedge fund, we recognized that we were seeing this bizarre behavior out of China where stocks were going limit up with no transaction because Western investors were trying to buy futures in Singapore, which, because they didn't have the ability to buy directly in China, they'd buy futures in Singapore. The index replicators would go from Singapore to try to buy in China. You'd have stocks in the index that were 5% float outstanding. They'd cause them to go limit up 10% without a single transaction happening. And what actually powered the Chinese stock market in that time period were these stocks going limit up with no transactions. The record was one stock went up 10% every single day without a single transaction for 32 consecutive days. Right? I don't care what you are. 1.1 to the 32nd power leads to a big company. Right? That's part of how I figured that process out. And we're seeing the exact same thing transpire today. It's just we saw the same thing in the dot-com cycle, just we didn't have limit up on the 10% feature. Right? So the prices could rise 100% in a day for smaller companies. On February 5th, 2018, the day the XIV imploded, something happened that never happened before in history. It didn't happen in 1987. Every single stock in the S&P moved in the same direction. All right? It then happened twice in the fourth quarter of 2018. It happened 3 times in March 2020. Right? So something that had never happened before just keeps happening. Right? Now we're back into a very low volatility regime. We can talk about that for a second. But if you're going to try to figure out what's going on with passive management, you have to actually figure out what's going on with active management. And so this is another area of research that I introduced. I went out and I surveyed active managers, and I asked them a question to try to establish effectively marginal propensity curves. right? What's your marginal propensity to buy, marginal propensity to sell? So I surveyed about 450 active managers. I asked them the question, you're a portfolio manager, you have 5% cash in your portfolio, you receive a new inflow or outflow, right? What is your propensity to buy or sell given valuation? Right? Now, totally unsurprisingly, the answer is active managers have a higher propensity to sell the higher the valuation gets. They have a lower propensity to sell the lower the valuation gets. The reverse is, of course, true for buying. That shouldn't surprise anybody, right? But what did surprise me was the intersection of the two, which was almost exactly the market's historical valuation average at almost exactly the 50-50 point. And all of a sudden, this actually makes a ton of sense, because what you recognize is if you have a market that's composed of active managers who have a higher propensity to sell on high valuations and a higher propensity to buy on low valuations, you get mean reverting valuations. Right? So the 16 times earnings actually has nothing to do with interest rates per se or growth rates or anything else. It just has to do with how active managers behave. Right? What happens if you introduce a player into the game who has 100% marginal propensity to buy or 100% marginal propensity to sell? They end up knocking the market off of that historical equilibrium. And so as you add passive strategies, you start raising those propensities to buy and sell. And if the market is actually characterized by passive share gain, on the right-hand side, you see instead of mean reversion, you get mean expansion, where every retreat ends at a higher valuation. Every ascent ends at a higher valuation, right? Until you get the XIV event where enough selling occurs in an environment that's dominated by passive, and you go to zero. All right, you lose control of the system. You'll notice, by the way, that the orange line stops. That's because it literally goes off the screen and then it plummets to zero, right? Which is a bad thing for a stock market, just to use technical terms. Unfortunately, this perfectly matches the data that we're getting. Now, I don't think that the market bottomed in 1974-75 because John Bogle introduced passive investing, right? That is a coincidence. But I don't think it's a coincidence that by 1995, 1996, we're off to the races in a totally different environment than we've ever seen before, right? And we've normalized this to the point that we're like, oh yeah, valuations rise. They must be better companies, right? Like, listen to how people at Google talk about Google and tell me it's this wonderful company. Right? It's like every other dominant company in history. It becomes overrun by bureaucrats and people who want to hear their own voices. Maybe that's my problem too. But the simple reality is that we construct narratives around this stuff. It's no different than the insider ownership in the 1990s or our stories about how the sun used to transit across the sky pulled by a golden chariot. Right? We are a narrative species. We seek explanation. And so when we see things like this happening, we come up with logical ones. Right, or what feel like logical. Must be better companies, right? Must be safer, must be more profitable, must be. Simple reality is we actually built it into the system. We've changed the character of the investors, and that's what we're experiencing. Okay, unfortunately, that's not the only way it influences this, and you guys will be able to get copies of this presentation. I apologize, I don't know how else to show this slide. There's another really critical difference between active and passive investors, which is how much cash they hold, right? And that doesn't really seem like a really big deal because traditionally active managers have carried around 5% cash. Passive managers obviously carry no cash. Most people think the answer to that is, well, market valuations might rise 5% if you switch all the way to passive. Turns out that that also is not true. And so I'll walk you through these numbers just to give you an example of how this plays out. And then the chart on the right actually illustrates it over time. Let's use a super simple model, right? There's $1,000 total invested in the market, or actually more accurately in funds that own the entirety of the market. They want to hold 5% cash. So by definition, there's $950 of equity and $50 of cash, right? This guy, Mike Green, comes along. He wants to try out this newfangled passive thing. So I say, give me 10 of my dollars back, and I'm going to put it with these passive investors. So no transactions have happened at this point, right? The active managers still own $950. They still hold 40 in cash, and this guy, Mike Green, has $10, right? He then gives it to the passive managers, so there's $950 in equity at active managers, 40 in cash, and 10 in cash at the passive. Again, no transactions have occurred. We're talking about a market in total, so me asking for cash, the only place I can get it is from cash, right? Now the transactions start. So the active manager wants to get back to their stable level of 5% cash, and the passive managers want to get to 10 basis points of cash. So the active managers need to sell $9.50, the passive managers buy $9.99, and everyone goes home happy, right? Except that's not how markets work. Markets can't settle if somebody tries to buy $9.99 and another person tries to sell $9.50. Right? The answer to this is that you solve it iteratively to figure out where that transaction would occur. And crazily enough, what you actually find is to get to 1% causes the market to rise by more than 1%. Right? That's on a 1% gain in passive. Now, it actually turns out as I do this over and over and over again, I get an exponential surface. So the more passive we get, the more richly the market is valued. Right? To kind of blow your mind, at around 80% passive, we should be somewhere in the neighborhood of a Shiller PE of 160. Right? At 100% passive, it's 900. Right? So like you ain't seen nothing yet is kind of the big takeaway, right? This is where it actually gets really hard because effectively what I'm telling you is from a Chuck Prince standpoint, like the music's playing, you got to dance, but boy, is this going to be an ugly hangover. Okay. The whole idea here, very straightforward, is that markets are inelastic. And the academics are actually beginning to recognize this and very aggressively talk about it. If you have not read Gabay and Koijen's The Inelastic Market Hypothesis, it's very readable. Even better is actually a variant of it done by J.P. Bouchard called a microstructure interpretation of the inelastic market hypothesis. These are fantastic papers, but the end result is ultimately that the price elasticity of the demand of the aggregate stock market is small, and flows have a large impact on price. Right? Now, the efficient market hypothesis and the Grossman-Stiglitz paradox, on which we largely rely on the idea of controlling the impact of these types of strategies, actually assume the exact opposite. So Gabay and Koijen's work suggests that the market inelasticity, or the price increase for a $1 into the market, is a $5 increase in market cap. The EMH specification is 1 penny. Right? So these flows are much more impactful and much bigger deal than people think. Right? We're off 500 to 1 on our specification. As I like to joke, that's not even good enough for government work. How does a market transitioning from active to passive behave? Well, again, like this is not a theoretical framework. I'm sorry, the focus seems a little off, but just so you know, the largest active fund is the Fidelity Contra Fund. Still remains the largest active fund. It's about $1 billion in total assets. Carries about $2.5 billion in cash. The largest passive fund is the Vanguard Total Market Index, which across its various implementations is about $1.6 trillion in market capitalization. It carries $80 million in cash. I mean, stop and think about this. If an active manager came into your offices and said, you know, we allocate capital in, we make active selections, and they said, we have $1 trillion fund and we're carrying $80 million in cash, you would throw them out of your office for being irresponsible. But this is how America is investing. Volatility on fundamental events like earnings announcements are rising as passive holders do not react to those events. Look, there's nobody from Vanguard on the Apple's earnings report. So if Apple has a terrible earnings report, they're not going to step in front of the active managers that have decided they need to sell. There's no information for them. Nothing has transpired. The only information they receive is, did you buy Vanguard shares? Right, so when that information hits, let's call it Facebook or Meta or NVIDIA delivers an earnings report, the only people left to transact are active managers in an increasingly thin and inelastic market. This is why we're seeing these crazy price swings. Right? It's not that like people are really that blown away by NVIDIA. It's just that half the market doesn't actually care and won't give you shares. The whole point of active management is the price goes up, the return going forward is supposed to be lower. So we're supposed to supply shares, we're supposed to supply liquidity in that environment. Passive managers don't. They actually do the opposite. The next dollar that comes in buys more of that name. This in turn leads to another academic paper. This is Valentin Haddad, How Competitive is the Stock Market? He's examining the dynamics of inelasticity, and importantly, he's running, so on the y-axis we have the inelasticity, right, or more accurately, the elasticity. The higher the number, the less the change in price for a change in supply and demand. Notice something, as market capitalization grows, elasticity disappears. It goes to 0. Why? Because if I buy the S&P 500 fund and they say, you know, Apple price or Microsoft price is a little higher today, sure you want to buy that? Yes, I want to buy it. It's 6% of the index. I have to buy it. I don't care what the price is. I'm perfectly inelastic in my decision. Right? So everyone thinks the story is like, well, this should be affecting the smaller companies more. No, it affects the largest companies more. And it reinforces the underlying momentum. Quoting again from Haddad, the large increase in passive investing over the last 20 years has led to substantially more inelastic aggregate demand curves for individual stocks. When demand is more inelastic, small changes in the market structure can have a large effect on prices because investors are unwilling to change their positions. Now, if you read Haddad's paper, you'll hear that they scaled the presumptive impact on the market by that 15% market share. If you use the 40% market share, it's a much bigger number and a much bigger change. Passive model allocates money to the largest stocks, drives them higher, and of course, once again, regulators are in here to help. Right? So when we actually look at the prices going higher and then the passive steps in and says, oh, we got to buy them in that proportion because that's what the index is doing. Well, ironically, we have structures in place that are meant to prevent that from occurring. The 40 Act has limitations on how undiversified a fund can become. Except the SEC says, yeah, it's not a problem for you. Right? As an active manager, if I allowed myself to become as concentrated as the S&P 500 growth or the NASDAQ 100, I would actually be in violation of diversification rules. But because I'm a passive investor, I'm not doing anything wrong. And the SEC allows me to market non-diversified funds. I mean, crazily enough, look at the weights in something like the SOX index or the XLK. I mean, you got stocks that are, or even the XLE, the energy stocks, right? ExxonMobil and Chevron are each 40+% of that index. Right, so when you go in and buy it, it's an incredibly undiversified product that is marketed to you with no restrictions. Okay, it's not just equities, it's bonds. Who was buying all the negative yielding bonds? We were told all sorts of stories, right? It's duration matching and asset liability matching in Europe, et cetera. That's not who it was American retirees. Why? Because if you buy bonds on a market cap weighted basis, a bond that goes from par to 150 is more attractive. Right? Now that's actually clinically insane, but that's the way the model works. And so who are the largest holders of negative yielding German bonds? Vanguard, BlackRock, Capital Group, all target date funds, all using passive strategies for bond indices. Reduced ability for new companies to become public. This feels more accurate today than it probably did in 2020 and 2021, but it's actually 2020 and 2021, the SPAC dynamic was a function of passive. So let me just walk you through this. Fewer IPOs, more SPACs, why? So the number of IPOs in the United States from 1999 to 2019 fell significantly, even as market values rose, until SPACs showed up. What's crazy about this is that SPACs were an index arb play that nobody talked about in that way. Right, so this is the actual methodology for the CRSP indices that's used by the Vanguard Total Market Index, BlackRock's Total Market Indices, et cetera. Again, I apologize, it's very hard to show all this sort of stuff, but if you notice, you'll see that SPACs, which I've highlighted in gold, are ineligible for index inclusion. Sounds like it's not a big deal, right? Why should it have any impact? Well, it turns out that once they made an operating acquisition, then they became eligible for consideration. And if they made a large enough acquisition, such that they cleared the 15th percentile or 85th percentile threshold of the Vanguard Total Market Index, meaning they were in the top 15% by size, they became eligible for fast-track IPO status, which meant that Vanguard and BlackRock had to buy their positions in as few as 5 days. Right? The rules on SPACs are pretty straightforward. Most of them have a limitation on insiders selling for at least 20 days. It has to exceed a certain threshold in terms of price for at least 20 days before insiders can start to sell. Well, what happens when Vanguard and BlackRock show up and try to buy between 7 and 15% of something, and the insiders, who are the sole source of shares, can't sell? Prices go vertical. And we get the SPAC nonsense, where it was, oh, you know, the reason why SPACs are working is because management teams aren't constrained by the language that they can use in the same way that they are on traditional S1 prospectuses and roadshows. Really? The reason why WeWork could only get public as a SPAC was because Adam Neumann wasn't promotional enough in his S1 prospectuses? Come on. Right? It was an index arb story. And they've taken it out, and guess what? They've actually reversed it. They've gotten rid of the fast-track IPO dynamics, and there's no more SPACs. Okay, by the way, just to prove the point, largest holders of things like Nikola, Tesla, or Nikola, and all these sort of nonsense SPACs. Turns out Vanguard was definitely there, as was BlackRock, et cetera. Big buyers, even well past the point that we knew they were outright frauds. How else should a market transitioning to passive behave? Well, it should be increasingly negatively skewed, because suddenly you've got a player who, when they decide to sell, doesn't care what the price is. Right? And this is unfortunately exactly what we're seeing. You can run this analysis. The distribution of daily returns for the S&P 500, the NASDAQ, the Russell, and inverted for the VIX has become increasingly negatively skewed. Okay, and this then opens up kind of the most perverse aspect of this, which is when we think about how markets work, we're immediately drawn to the work in the 1940s and 1950s around modern portfolio theory, which holds that asset returns are somewhat modeled as normally distributed around an expected return. Right? When time becomes a proxy for passive penetration, though, that starts to break down, right? I've shown you how we've now got an exponential surface. We've got a rising valuation, which all else equal inflates valuations, raising returns. And so it turns out that alpha, the metric that we use for measuring managers, is really just the intercept on a linear equation. Y equals mx plus b. Portfolio return equals market return times beta of the portfolio plus some idiosyncratic number we call alpha. Right? We're all CFAs, so we can do math. What happens if you use a linear solution to a curved surface? Well, your answer depends on when you measure it. Turns out that as you go forward in time, that curve becomes steeper and your alphas are forced negative. This is, unfortunately, exactly what we're seeing in the data. Right now, the alternative interpretation is that the game's just getting harder. Right? That active managers are getting worse, or that because the average participant has moved away from doing crazy things like buying technology stocks in the dot-com cycle, it's become much harder, and therefore we have to work much harder, and eventually if we just work harder and harder and harder, then we'll finally start making money again, right? That's total crap. It's a math problem. Right? And part of the problem is we were all heads of like the AV squad. We didn't, we weren't nose tackles on the football team or quarterbacks. And so we're all a little embarrassed by our success. Like, do you really want us to be like, yeah, I mean, I'm underperforming the S&P, but I get paid really well. Right? No, we take it. We're like, please don't notice me. And unfortunately, all of this is getting worse, right? The retirement options are increasingly on autopilot. The target date funds are being enhanced by model funds, right? We're seeing this in the behavior of financial assets in which, crazily enough, like bonds have gone from zero yield to amongst the highest real yields we've seen in multiple decades, and theoretically nobody wants to buy them now. Right? Why? Because we have sticky allocations and strategies like target date funds. Right? Target date funds don't change their allocations based on coupons. If you actually look at Vanguard's website, they will very helpfully provide you with a calculator that says, here's your expected return to equities, here's your expected return to bonds if you run through a retirement simulator. And guess what? Those haven't changed at all in the last 5 years. Even as bond yields have gone from 0 to 5%. Like, that's kind of the definition of garbage in, garbage out. Okay. Why do we go down in 2022? This is one that always puzzles people. It actually turns out that part of it is a function of positioning, right? But a much bigger part is actually, let's see, I want to see if I can find this here. Okay. So a much bigger part of it is actually because of these rigid allocations. What happens if I have a portfolio that is required to rebalance on a monthly basis to, let's just make my life simple, 50-50 equities, bonds, and a deus ex machina force we call the Federal Reserve hikes interest rates, pushing bond prices down? Right? My bond portfolio has fallen. I have to maintain my allocation. What do I have to do? Sell equities, buy bonds. Sell equities, buy bonds. Sell equities, buy bonds. Right? That's exactly what happened in 2022. And once the duration sensitivity of the bond portfolio had lowered to the point that it wasn't having a huge impact anymore, and the Fed began moving from 75 basis point hikes to 25 basis point hikes to no hikes, then the equity markets can take off and the process can continue. What can we do? First, look, there is no passive investing. We've been sold a lie. It's really important for people to understand this. These are algorithms that are investing under a certain framework. That framework has a predictable impact on markets. We're seeing that behavior, and yet nobody wants to talk about it. Fiduciary, you guys are in a tough spot, right? We're all in a tough spot because you're going to get sued if you pick active managers, and you're going to get sued when your passive collapses. I think the answer to that is make sure you have a good lawyer. You have a duty to understand and be informed. That's all you can really do at this point. Realize that any backtest of historical returns at this point is hopelessly corrupted by the data that we've received. Right? Equities do not return 12% a year. I'm sorry. That's just not the way it works. Right? Equities assisted by the growth of passive very well might. And by the way, if this continues, once again, that Shiller PE at 160 or 900 is out there beckoning, right? So the system will collapse under its own forces and volatility before that occurs, but it could be a fun ride as you get there. Education, look, the CFA, part of our role is to educate people and talk about this stuff and make sure our clients are aware of it, make sure policymakers are aware of it, et cetera. Candidly, I think we're falling down on that. From a policy standpoint, things that we can do, create diseconomies of scale. Look, the simple reality is that Vanguard and BlackRock are systemically important financial institutions. And yet they rely on the market for all their liquidity provision. There is no equivalent of the Lehman unwind or the requirements that they'd be able to show, here's how we get ourselves out of this position. The scariest thing I heard from the pandemic, this tells you what a nerd I am, was Vanguard making a self-congratulatory release in April of 2020 that less than 1% of their clients tried to change their allocation. Less than 1%. What if it had been 2? We need to end preferential treatment of quantitative strategies. This is a great irony because our firm is largely quantitative in its construction. One of the reasons we gravitate to that is guess what happens if you run a quant strategy? I can create an index, I can backtest it, and I can be like, this is what I expect it to return. We're all participants in the medium. That's actually very dishonest in his presentation because nobody was trading it. This is exactly the message that I conveyed to the founder of the XIV when he asserted that it would survive the crash of '87. You weren't trading the product then. There's no possible way you can make the statement that you think it would survive the crash of '87. Enforce diversification rules. That's pretty straightforward, right? If we're selling undiversified products to retail investors that are supposed to be only buying diversified products, that seems like a bad idea, but it's currently allowed. Enforce antitrust, right? This has become particularly important to me as a firm. The simple reality is that our industry is consolidated to the point that there are gatekeepers and toll takers at every step in the process, all of whom are fighting against the reality of the importance of diversification in investment styles and everything else. This is one of the things I really want to point out. There's actually a critical value associated with introducing something like passive. You've created a player, you've created a member of the ecosystem that has a different set of rules. Right? And diversification of why people buy facilitates liquidity. So having somebody out there is like, oh yeah, I'll buy, I got some money. right? Like that's really helpful. It's also super helpful if you're, a retailer trying to clear out Christmas stuff. But in a market, it actually lowers volatility up to a point. The problem is that point was about 20%. And today we're at 40, headed towards 60. And open market buyback operations and accelerated share repurchases, right? This seems out of place, but the simple reality is that the same underlying dynamics of much lower than anticipated and understood inelasticity or elasticity in markets means that open market buyback operations are stock manipulation, right? They are not the same thing as dividends. You're actively in the market buying shares. That is a different animal. It has different impacts. And candidly, the fact that we continue to have it is a giveaway to the executive class. And the last component, and this is one that I think is only understandable at a CFA type speech, we're asking markets to do what they're not designed to do. Markets are not about delivering retirement services. Markets are about allocating capital. Right? And so when we start using language, it's about, well, you should expect X from the market. The market has no obligation to deliver you X. Drove him out. The simple reality is that they're about allocating capital. And we should be trying to figure out where the next dollar of capital is going rather than saying, I'm really trying to make that 8% or 9% or 10% return that allows my grandma to retire without any impact on her spending pattern. Okay, so last way I like to finish this off, those who can make you believe absurdities can make you commit atrocities. We know that markets aren't passive. We know there's no such thing as passive investing. We know that we're impacting markets. We all feel it at this point. We've got to figure out how to stop it. With that, I'll end it. Open it up for questions. Yeah, so those are important points, but I do want to take you back to this chart because this is really the kill shot on that point. So this is Valentin Haddad's paper. It's an excellent paper, really readable. But it also feeds into a second layer of research out there, which is around the dynamics of market impact, right? And so it turns out that market liquidity doesn't scale with market capitalization. It scales with volume and volatility. The higher the volume, the more liquid the stock is. The lower the volatility, the more liquid the stock is, right? Microsoft's $3.2 trillion in market cap right now, I think, roughly. It is not 32 times more liquid than a $100 billion stock. It's maybe 5 times more liquid, right? And so what you're actually seeing here in this dynamic of reduced elasticity is exactly that dynamic of market capitalization not matching up against liquidity. And as a result, the dollar into an index fund that's trying to spend 7 cents on Microsoft is having a larger impact on Microsoft than it is on that smaller stock. In general, you're not seeing a ton of illiquid stocks in the S&P 500 in particular because it just selects out, right? You need to have levels of insider ownership or float. You need to have levels of volatility. You need to be of a certain size, et cetera. You see more of that in kind of the break into the total market or the extended market indices where very small cap companies will come in. Meme stocks carry some of those characteristics. So like we do see that dynamic. But ironically, the biggest impact is on the Apples, Microsofts, et cetera, of the world.
When you say Microsoft, you say like 5% daily volume or 30%? That's not 0 to field.
I'm going to say that Microsoft is probably 1% to 2% of daily volume, at most. Yeah.
Thank you for your insights.
Oh, thank you. I appreciate that.
With regard to stock buybacks and lots of cash flow, do you have a vision on what's going to happen with that with regard to Apple stockholders?
Oh, boy. Quick answer is no. I wish I could tell you exactly. I was having a conversation earlier. We were talking about the dynamics of everybody's going to have a different interpretation of how to use this type of information, right? It turns out there's all sorts of interesting patterns out there. The dynamics on the single stocks, ironically, I would highlight that the players like Millennium and others who specialize in index arbitrage, et cetera, those guys have this stuff down cold. Like they're really, really good at this. Tesla's inclusion in the S&P 500 or SMCI's inclusion in the S&P 500 are among the most profitable events that we've seen in decades. Millennium alone, I think, made $3 billion on the inclusion of Tesla into the S&P 500. I don't know what the number is yet for SMCI, but I'm going to guess it's not all that dissimilar, right? So when you start talking about Apple and its buybacks and trying to offset the eventual sale from somebody like Warren Buffett, the quick answer is I don't know, right? There's going to be a lot of individual components. What I do know is, ironically, every day that Apple is out there buying back shares, they are reinforcing that passive bid and pushing it even higher, which then creates a feedback loop of momentum dynamics. Yep.
Sort of dovetail both those questions. First of all, doesn't this mean that like index reconstitution, like the argument that we put it in, right? You can figure that out. And then secondly, is there anything from a policy standpoint that would change the, you know, like is the government looking at these things like, wow, this is going to, you know, way too, how the, what basic changes there? I mean, we're talking about this about time, but I'm just curious if like anyone in policy comes like, yeah, this is great to do, we should make changes so that it should be just not that way, but should be our speed versus that.
Yeah, I mean, so the quick answer is it's very hard to make anyone understand something when the checks are being written by Vanguard and BlackRock, right? So there's actually a paper by Ken Anadu of the Boston Fed that you could, it's called, Do Index Funds Represent Systemic Risk? I think is the title of it, right? And you read this thing, and it's one of the best he said, she said ever, right? So it's after me talking and presenting my work to the Boston Fed and them doing what you would expect them to do next. What would you do next? No, you wouldn't. You'd call Vanguard and be like, oh yeah, what about this idiot Mike Green? And Vanguard would be like, oh yeah, we know that guy. He's an idiot, right? And they might be right. But the simple reality is that they then turn around and say, oh, that's all bullshit. I think that's the technical term for it. That's not what's going to happen at all. Right? And you read this piece and it's like, well, some people say this and other people say this, right? And that's the way the system goes. When I gave this presentation to the IMS Financial Stability Group, the group that's technically charged with maintaining this, and by the way, this is not just a US phenomenon. The fastest growing passive, Larry Fink just noted it for you and said, we should really adopt that as our retirement system. Anyone know what it was? Superannuation in Australia. The rules in Australia are so crazy at this point that if you are a member of superannuation, you've been approved for participation in superannuation, if you underperform your benchmark for 2 years in a row, you're kicked out. So guess what everybody does? They index. Fastest growing indexing on the planet. Larry Fink is a big fan. Right? You know, it's unfortunately, that's just the way the thing works. And so when I talked to the IMS Financial Stability Group, I literally went around the world trying to say to people like, please tell me how I'm wrong. I want to be wrong on this. Please, please, please tell me I'm wrong. The IMS Financial Stability Group came back and they're like, yeah, we think you're right. I'm like, oh my God, that's awesome. Like, how can I help? What can we do? And they're like, there's nothing we can do. Because Vanguard and BlackRock own the regulatory apparatus. And if we were to raise a stink, we'd just get fired. So we have to wait for the event. We have to wait for the vol. This is in the aftermath of Volmageddon, by the way. We have to wait for the Volmageddon type event.
Do corporate executives in the largest companies that are having their valuations expanded, do they feel a responsibility to issue shares in the face of higher valuations?
You would think so, except they're all buying back shares. Right? So like, this is one of these great things where in theory, like the answer, you know the answer to this, right? The cost of capital should fall so low that companies turn around and take advantage of it and increase their issuance of equity shares. Right? We know the theory, we know how it's supposed to work. Unfortunately, that theory ran into something called the empirical. Right? And it's not happening. We're seeing the exact opposite, right? These companies are actually able to keep their labor costs, among other things, they're able to keep their labor costs significantly lower than they otherwise would be. Let's forget the fact that they're stealing their technology and shipping it to low tax havens. I'm increasingly sounding like a communist. But the simple reality is they're not doing it, right? And so like they're blessed with low cost labor. When the labor exercises their warrants or their stock options, their employment stock options, what does that do? That gives more cash to the company. It's like selling shares to their employees, and then they use that cash to buy back more shares, pushing the prices higher. Right? Like it's doing the exact opposite of what we were told it was supposed to do. And we need to actually acknowledge that and be like, wait a second, that's not how the system's supposed to work. I know I'm thrilled from an asset owner perspective that they're handing this back, but we're breaking the markets on which we rely. Yep.
I remember listening to a presentation you did a few years ago. You mentioned that demographic changes with boomers, especially in their retirement, in their target funds, they eventually become sellers of equities and buyers of bonds that they got more expensive.
Yep.
Kind of since that period, what are some trends that you've seen since then?
Yeah, I'm looking for, let's see, for the right chart here. Boy, I don't really have it. You know what? Actually, this is probably the best one to talk about it with. So this is one of the things that I emphasize. Like, I'm learning as I go through this process as well. And one of the things that I didn't fully appreciate was how heterogeneous the distribution was at that point. And so the demographic story about the boomers selling only actually works if they're selling the same type of thing that the younger generation is buying. And so when you go back and you look at like the Gabayan-Koijen multiplier, that 5x multiplier, I've done some work to differentiate between active and passive investors. This also plays into Valentin Haddad's work. Because the passive indices are perfectly inelastic, right? In an actual perverse way, they're almost negatively elastic because as something goes higher, they allocate more capital to it. It actually perversely leads to it not really mattering until passive gets sold. To put numbers on the multiplier, my estimate is that active manager multipliers are about 2x. In other words, $1 in creates about $2 of market cap, and that's very simply because if prices get too high, they just hold that cash, right? Passive doesn't work that way. And so my estimate on the passive multiplier is like 17, right? And climbing. As the market gets more and more passive, it has a bigger and bigger impact. So like that's why I think this hasn't happened. Now, with that said, one of the things I'm monitoring really closely is we're getting to the point, like this is one of these crazy statistics. When I started talking about this in 2016, the average age of a Vanguard client was 37. It's now 51, right? And the reason why is they don't get any younger, right? And their client base doesn't change, so they're just adding to it over time. Now, to put that in perspective, the average age of a client at Morgan Stanley is 71. So like, their clients are just dying off. And their kids aren't staying with Morgan Stanley. Their kids are flipping over to low-cost indexing. Yeah, back.
So how important is this factor of indexing, active versus passive, abroad versus U.S.? Because that consistent amount of performance abroad.
It's the exact same thing you're seeing with small cap. And so, let's see, where do I have? This is the chart I want to show you. I mean, either of these would work, right? It's an exponential feature. And so it's a little bit like running a marathon with a big hill in the middle of it. The first person over the hill tends to win the marathon. Right? Like everybody has to fight the hill. But if you're first over that, then you got the tailwind and you actually can put on additional distance versus everybody else as you're going down that hill. The US has the same underlying phenomenon where our passive is far enough along and growing on that exponential curve in a manner that pulls us away from the rest of the world. Right? So again, like, listen to the narrative. The U.S. is the best place. It's the most wonderful place to be doing business. Yes, we're totally dysfunctional, and yes, we can't get our budgets under control, and yes, our educational system is terrible, and yes, we're overrun by immigrants, and no, we don't have enough workers, and all the complaints that are out there, but somehow or another we have the best stock market, right? Like, I actually just want to be very clear. I don't think everything is about this, but it's a big part of it.
Talk a little bit about what self-correcting mechanisms, like I look at it from the guy was associated that vertical farm expansion, total market capitalization increase.
Which is exactly what we're saying, yeah.
Economic activity needs to then to raise rates that then creates a corrective mechanism. And so this that forward and at what point is that dynamic involved?
So now you're asking me to stretch a little bit into like the real world impacts of this, and the answer is yes, it does. Right. One of the simplest ones is actually if you look at the rising inequality that's occurring within our country, it actually turns out that it's not a uniform distribution. Basically, the single biggest predictor of are you becoming rich is do you work for Google, Microsoft, Apple, et cetera. Right. So your luck in employment increasingly determines your fortunes. Right? That's one component of it. The second component of it actually plays through in things that unfortunately bear a lot of similarities to previous times in history, whereas prices move higher. Most people are not looking at, like, I look at it and I see prices going up and I'm like, oh my God, like, stop spending to my wife, right? Which she's always very happy to do. Anyway, I'm very lucky on that front. But the simple reality is that I look at it, I'm like, that's less stable. And most people look at it like, ooh, prices are higher. I'm richer. I feel so much better. I can spend more money, right? And so it creates this type of dynamic. Unfortunately, the same thing played through in the 1920s. The difference in the 1920s was stock ownership was 10% of the population. Today, it's 56. Right? So this is a much bigger problem. And our entire retirement system is built around this. Right? So I don't have a great answer for you other than to say the data that we're receiving is, I would argue, increasingly skewed by some of these dynamics. Right? And ultimately, it can create a phenomenal sugar high. I think we're experiencing an element of that. Right? It also, this is just a very quick component, it just separates society into those who own assets and those who don't. Right? So those who are not participating in this false bid for the stuff that they happen to own, either due to historical endowment or the fact that they happen to be, in an income earning position where they can generate a surplus or get 6% employee matching in their 401k, or happen to work for Amazon, Microsoft, et cetera, so their stock options appreciate dramatically. There's no overcoming that.
Talk a little bit on how other non-fundamental strategies are impacting the markets, and high frequency trading, quantitative, we talked about Millennium, multi-managers who are highly levered. How does that play into some of the changes we've seen in the past?
So the quick answer is I used to have a chart in here that shows how hedge funds have actually changed. Right? They went from 0 market beta to today they run on average about a 0.87 market beta. Right? Everybody has to get on board this game. Right? This is the music is playing, the chair, you got to get up and dance, and when it stops, there's going to be a hell of a game of musical chairs to rush for the last remaining seats. But the music is still playing, right? We make fun of the Chuck Prince quote because the music stopped playing right after he made that quote. Right? I've been talking about this for 8 years now, right? And the music's still playing. And I had anticipated that it was going to play for a very long time, but part of what I'm trying to do is make it so that when the XIV collapses, except the 3 digits are replaced with SPX, right? That Vanguard and BlackRock aren't able to go like, oh my gosh, could you imagine? How could this happen? Like, we had no idea, right? It's willful blindness at this point.
How does the growth of the private equity world influence your thoughts?
Unfortunately, there's feedback loops there, right? So they naturally mark themselves against public equities when convenient and don't when not convenient. So that has contributed. The neglect that occurs for smaller companies in this type of framework, right? They don't get that same upward pressure or to the same extent, and so they become cheap relative to alternatives. All of those have contributed to the degree of M&A and consolidation that we've had, where there's a very different cost of equity for Apple than there is for a small company in the Russell 2000, or even worse, something in the Russell Microcap, for example. It's contributed to the consolidation and the reduction in the number of publicly traded companies we have. It also has contributed on the fixed income side, the duration bid that occurs when the Fed cuts interest rates, right? So again, let's reverse that Deus Ex Machina impact comes in. The Fed starts cutting interest rates. What are the bonds that respond best? Relatively low coupon, long duration bonds. Right, that makes financing on longer term basis easier. So I think that there's feedback loops that are tied between the two, but candidly, private equity, for all the headlines it gets, is a pimple relative. The entire size of the cash on the sidelines of the private equity industry that we talk about, the ample supplies of cash, is less than half the market capitalization of Apple.
Thoughts or concerns on the volumes in the short vol trade? Current volumes?
So a lot of people ask me that because of the dynamics of XIV. I think we're in a very different. First, I just want to be clear. Like, me getting concerned about something never happens. The simple reality is that the setup is actually quite different. And so while I present a very short view, a shortened synopsis of what transpired with the XIV, there is a backstory there as well, which is. In 2008, when we adopted the Volcker rule, there's what's called CCAR provisions, capital adequacy ratio provisions. Under lobbying, there was a differential between expressing risk in short vol and expressing it as long equity. And so the Volcker Commission decided to set CCAR levels starting in 2009 until around 2017, where particularly foreign banks, if they were holding risk positions for their clients, they needed to have capital that that would allow them to survive an instantaneous 30% drawdown in equity positions. In short vol, right, which is historically a 4 times beta and rose to 22 times beta, they only had to have a 10-point jump in the VIX capital adequacy ratio, right? So it was far cheaper to express the trade as short vol than it was in long equities. And you actually saw this mechanically play out. If I went and bought the S&P 500, Goldman Sachs would hedge themselves by shorting the VIX, right? That blew up when the Fed changed the rules. So Volmageddon was February 5th, 2018. On February 2nd, 2018, the Fed quietly and unexpectedly changed those CCAR provisions to a 30-point jump in the VIX. That set off a scramble from foreign banks to buy back that risk exposure, which is what actually caused Volmageddon. So the kindling was there. It needed a match. The kindling is there today. I don't know what the match is. I don't think, so zero DTE is actually, first, like, there's all sorts of problems with zero DTE, but remember, it's cash settled, which is one of the easy components to it. The second is that it's a little bit like playing Russian roulette, right? It's a risk, but it's not really a systemic risk, right? It's a risk to you. And that is a critical difference, right? So, like, I'm concerned about zero DTE, and I'm concerned about the speculative excesses around it, but I'm actually not all that concerned about something that settles every single day. It can be a really bad day, though. Let's just be clear, right? It can be a bad day, but I don't think it creates a bad decade. Yes?
I think the government's changing the laws around retirement and withdrawal.
Yes.
Age. Do you think that having any other effect beyond just delaying the inevitable?
Oh, I think that it's designed to delay the inevitable. Right? I mean, we started to see 401k withdrawals in the fourth quarter of 2018. That's what actually happened to equity markets in the fourth quarter of 2018, was that the implementation of required minimum distributions initially required you to start taking them at 70.5 or 60, 70.5. In the fourth quarter of 2018, under the Secure Act, we changed that to 72. Then we changed it to Secure Act 2.0 to never, right? And now, like, there's some dialing back some of those components because the U.S. government needs revenues. But my perception is that those were changed to actually to prevent withdrawals. Did that answer your question, or? Yeah. It sucks. Yeah.
You're not very optimistic.
No, I mean, look, there's an incredible incentive if you're Vanguard and BlackRock to keep people in these products, right? One, it's profitable for you, and two, my sense is they actually kind of know what's going to happen if the selling occurs, but you can't actually go out and say that, right? So you do everything you can to build it up as much as possible. Now, I think part of the reason why Larry Fink is out there talking about things like superannuation and saying we need to do this is he's trying to position himself to do exactly what he did in the aftermath of the COVID pandemic, which is have the U.S. government turn to him and say, hey, could you fix this for us?
So it's focus on labor market.
I mean, you've done some work on this as well. I mean, I think the easiest answer is that we've actually taken, I wrote a Substack on this, we've taken what have historically been thought of as leading economic indicators, right? The stock market is supposed to reflect our collective judgment that says, do we think the market is, do we think results are getting better? Do we think cash flows are increasing? Do we think the discounted cash flow analysis suggests that it's more attractive today than it was before, right? Well, if we see a recession on the horizon, our natural response to that is to reduce risk. That leads markets to be predictive in terms of economic downturns, and they successfully predict 17 out of all 9 recessions, right? Because we get nervous, we get worried about these things, right? But if we replace those flows with flows that are simply tied to employment, then it actually moves to a lagging indicator. And that is actually, unfortunately, what seems to have happened. Any other questions? Oh, good.
What kicks off the event that we're waiting for? Is it just aging and people start selling some other equities and that creates a feedback loop? Or people say, no, Amazon or Apple's just really not worth this many. I'm going to sell a little of my index funds.
So the quick answer is we don't know. I'm skeptical of the latter, right? Because we've seen any number of attempts to do that. And how many people have read Reminiscence of a Stock Operator? Right? Okay, almost everybody has. Do you remember the expression from the wizened pit trader, I think his name was Doc, in terms of, he was approached by somebody and said, hey, you should really buy into this. It's got a great name. And they came back later and like, well, you should sell. The catalyst has been realized. It's like, but I'd lose my position, right? That's really kind of where we are. There's been a lot of smart people, I don't happen to be one of them, but there's been a lot of smart people who have come out and been like, oh, this is crazy. We're in a bubble. You should probably sell. We should reduce risk, right? We call those former portfolio managers, right? And so we're now kind of at a point where I think everybody is understandably just scared to death, right? They're more scared of selling than they are of buying, right? Because the career risk is existential at this point. And so I think it's really hard to have the discretionary sales become large enough. I think, unfortunately, you end up with the forced sales, which is a combination of unemployment and retirement. The retirements are largely in place, just to be clear, right? It's that second part of the equation that becomes really interesting. And the quick answer is, I wish I could say to you, this is the catalyst, right? Beelzebub comes down or comes up and appears to us as the son of, revelations, oceans boil, et cetera, right? But like that's what it's going to feel like, but it'll just be happening on our little black screen. Any other questions? Okay, everyone feel suitably red-pilled now? All right, thank you very much, everyone.